Hello, and welcome to Navigating Seasonal Cycles with Jake Bernstein. The information provided in this episode is for educational purposes only. There is a risk of loss in all trading and investing. The results shown are hypothetical and should not be construed as investment advice. And now, over to you, Jake.
Greetings, everyone. Thank you for being here today. I'm going to begin with an apology and an explanation. The apology, my voice or lack thereof. Thank you for putting up with it. While you may think that this is Robert Kennedy of HHS speaking to you, it's really not him. It's me, Jake. I want to tell you how my voice got to be this way so that you'll be patient with me. Ironically enough, when I was 7 years old, I had polio. I was paralyzed from the neck down and spent almost 2 years in one of those big iron lung contraption machines. Unfortunately, I regained my ability to walk and talk, and everything was fine until many, many years later, I came down with what's called post-polio syndrome. Now, backing up a little bit, interestingly enough, had there been a polio vaccine when I was 7, I would have had the vaccine. I would not have the issue I have today with my voice and joints. But ironically enough, as I said, Kennedy of HHS has spoken badly of the vaccine. And unfortunately, if people don't get the vaccine, there's going to be hell to pay. But that's just my opinion. So, as you do, please pay attention to the quality of the information as opposed to the quality of the voice, and we will be fine. I will do as best I can to speak clearly and hope you understand what I'm telling you here. My goal here is not to sell you anything, not to give you anything that is complicated, but to tell you something, to give back to the community, to give back to an area of business that has meant so much to me, not just financially, having made me very wealthy with the opinions that I've been expressing to you based on research, but also giving me the opportunity to meet so many good people in the cycles community. So today, as in most cases when I give a webinar, I'm not being paid to do this. I'm not paying anyone to let me do this. I want nothing from you except your attention and your understanding of what I'm saying to you. My specialty, other than long-term cycles, is seasonality. You've seen me speak about this many times before, and perhaps you're getting tired of it. But I say to you, don't get too tired too soon, because the best is yet to come. I'm looking here at a seasonal composite chart. This happens to be a chart of 3M, going back to 1970, coming through to 2025, which is a vast amount of time. As you know from the ability you have to trade and from what you've been exposed to in trading and investing, most people, most analysts, don't like to look back that far. They like to look only at the last 2 or 3 years, or perhaps the last quarter, or perhaps the last month, because they're afraid that if they look too far back, there will be no consistency. They'll find that things are unpredictable. I believe otherwise. I believe that we need to look at as much data as we possibly can, and certainly that's the mandate of a true quality professional cycles analyst. My forte, as I said, is using cycles and repetitive phenomena to generate financial opportunities for investing and or trading. And I say this very succinctly because our work is succinct. I'm not interested in guessing. If you attended the annual forecast of the foundation late last year or early this year, you'll recall some of my predictions, such as new all-time highs in gold, big bull market in silver, big bull market in stocks and so forth, all of which was based on cycles and seasonals. So I come to you today to tell you what I expect to happen based on seasonality beginning in October and running through the end of the year, because the pattern is quite clear. The pattern to which I refer to is the so-called year-end rally. By the way, if you decide to look at the closed captions, if we're running those for my presentation, please pay close attention because sometimes it puts words in there that I didn't really say, or it puts words in there that I think I said, and sometimes it can be quite amusing. Okay, so let's look at the chart. This is not a chart of 1 year of 3M, but a chart of many years. And what I did, and I've shown these charts before, I've taken mathematically every year of this stock and done a conversion. I've converted the high of each year to 100 and the low of each year to 0. So we have what's called a normalized chart. No 1 year or 2 years or 10 years is going to impact this chart in terms of the trend, other than the pure, what I call DNA of the market. In other words, 3M has had a tendency over the course of many years to display this kind of behavior, namely making a low toward the beginning of the year, reaching a high toward the middle of the year, correcting down, and then ending the year in a very strongly bullish fashion. Now, you may not think of this as a cycle, but if it's a repetitive factor, a repetitive phenomenon, which can be demonstrated mathematically, which is what we're doing here, then as far as I'm concerned, it's a cycle. Depending on how broad or narrow your definition of cycles is, you will either be a perfectionist or a pragmatist. I prefer the pragmatic approach. What the pragmatic approach tells me is this. It tells me that in late September, early October, this stock, 3M, begins to go up. It tends to go up significantly, ending the year on the high of the year and encompassing a range from year to year, which is equivalent to about half the range of the entire year. I consider this to be a phenomenal opportunity to invest, to make money, and to trade, specifically from the long side, from the buy side, because that is the path of least resistance. And certainly, being philosophical about it, I've learned after 55 years of trading that the path of least resistance is my favorite path indeed. But there's more to it. Within the big picture, we know that even though this is the DNA of the market, of this particular stock, we also know that the percentage of time it does this, even if it's 70% of the time, that does not account for the 30% of the time that it doesn't do this. So in other words, as you know, 70% ain't 100%. So within the big picture, within the framework of an investment strategy, I call this a setup. A setup needs a trigger. The trigger says, yes, this setup is likely to occur this year. And the trigger needs a follow through, which says, here's how to manage this investment or this trade. In addition to this information, you'll also notice at the bottom of the screen, I have arrows up and arrows down. Arrows up indicate that this particular move for this particular week in a green arrow has been up X% of the time. That's X number of years. And you see the number 60 in there. So this 3-week period, last week May, first 2 weeks of June, with arrows up and high percentages, has been designated by the computer as a period of time during which this particular stock moves up. Now, on a broader basis, consider the implication of this chart. If we could do a chart like this on corn, or soybeans, or sugar, or coffee, or cocoa, or other food commodities, and if we could use this information for planning purposes, or planting purposes, either planning and or planting, if we could use this information to predict when would be the best time to harvest crops, When would prices be at their highest high or their lowest low for the year? We could certainly do a great service, not just to our finances, but to the world in general, in terms of food and geopolitics, especially if we look at a chart like this in a market such as crude oil. But that's a whole nother story. Let's focus on what I came here to do today, which was explain to you what I see happening based on this repetitive pattern into October, November, and December, not only in specific stocks, but in general, the overall market. And how are we going to do that? We're going to do that mathematically and statistically. And again, apologies for the rough voice. I hope you like the information enough to overlook the voice. So let's go to the top of this screen and bring up another chart that I hope will be instructive for you and explain more clearly what I'm talking about. Just one moment, please. Here we go. Just bear with me. So we're going to go up to the top here, and we're going to select something else. We're going to select the Dow Jones. Just one moment, please. Just bear with me. Seasonal charts, US stock charts. We're going to go to the Dow Jones. I'm going to pick the Dow to get an overall view of the market in general. Just one moment, please. Computer is thinking very hard. And we're going to go to our Dow, and as you can see, we have many stocks listed here. We're going to come all the way down to the Dow Jones. And we're going to ask a question that may seem improbable to many people. And that is, has there been a tendency, a predictable tendency in the Dow Jones over a long period of time? Let me show you how we do that. Dow Jones, we're going to go to 1950. So we're looking at a big chunk of data here, 1950 to 2025. So we're looking at a massive amount of history. And you'll notice, very interestingly enough, that this chart of the Dow Jones, which has nothing per se to do with the 3M chart we showed before, looks very similar. And what does it show? Here's where we are right now, end of September. It shows October and then into November and December with a strong move up toward the end of the year. And please observe these arrows at the bottom of the screen. Every arrow that's green, pointing in the upward direction, is a statistically significant indication of a move to the upside. So the expectation is very specific, very real, and founded not on opinion, not on economics, not on analysis, not on opinions based on company earnings, but simply based on history. For whatever the reason, and mine is not the reason why, mine is but to sell and buy. For whatever the reason, this period of time has been the most predictable of the entire year and accounts for the so-called year-end rally. The real question is, will it happen this year? We could answer that question in a number of ways. The first way would be to say, let's look around the world and ask what the geopolitical situation is. Is the geopolitical situation such that this move into the end of the year is possible? The answer would clearly be no, because the world situation is in a god-awful mess on the brink of war in practically every corner of the world. Lies, obfuscation, political violence, people protesting, dictators wielding their power, you name it, it's problematic. So anyone looking at the fundamentals, the geopolitical fundamentals, would say, this can never happen. Not this year. Then again, one could say the same about what's happening now. After all, the cycles late last year and early this year allowed me to predict a bull market for this year and new all-time highs, and that is certainly happening in spite of all the turmoil that's happening in the world. So we can't look to that situation. What can we do? You can ask the question of AI and say, AI, tell me, how often has this happened when the contrary opinion has been, when the world situation has been negative and not supportive? Or we could ask AI another question. What additional factors would you need to increase the probability of this particular move occurring? And that to me is the best answer. What we can do now is we can go to our traditional technical analysis or our cycles. So what can we see from the chart? Let's look. 1950 to 2025. We were talking about a vast amount of years and years, that same pattern. Still looking very good from now until the end of the year. So what's the best thing to do now? We can do further analysis, as I said before, using traditional technical methods, asking the question, is the trend now up or is the trend now down? If the trend is now up or turning up, that increases the probability that this year-end rally is going to happen. If the trend is now down, it says wait until the trend turns up to take maximum advantage, assuming, based on the fact that the current trend is up, that this year is doing what the quote-unquote normal year would be doing, period. So let's take a closer look. We can also zoom in on this. Let me show you what I mean. If I click on my chart, I can expand this to a daily chart and see what happens by exact calendar date. Sometimes this takes a few moments to load. Here we go. So this is October. And this is my DNA roadmap for the month of October, which basically says we end the month of October higher. And by the way, this is a daily chart. You can see the calendar dates right over here. Week number 1, week number 2, week number 3, and so forth. So we can say October tends to end higher than it starts. There are a number of positive indications here. Green, there's a few corrections down, but the last 2 weeks, 3 weeks of days, I'm sorry, the last 3 to 4 days of October tend to be very strong. So this would be a more granular look at what's happening for the shorter term trader or investor. Let's go back to the weekly chart. Let's look at something else that I think you'll find truly amazing. I'm going to go back to this chart right over here and I'm going to say, okay, we've seen everything back to 1950. Can we go back further than that and look at more data? Well, certainly we can, because remember, the more data we have, more confidence we have in our methodology being correct. So let's go to 1901. Now I ask you, who in this business of trading or investing is willing to go back to 1901 and look at a massive amount of history to answer the question, what's likely to happen right now, and has there been a tendency for things to move in a certain direction at this time of the year? Here we have 124 years of history. And by the way, most people in this business don't even have that history, let alone use it. So let's look at the chart. And let's answer a few questions that you may be thinking about right now. What does the chart say? First of all, the chart says we end the year higher than we begin the year most of the time. The chart says that this period of time that I've previously highlighted, October through the end of the year, has a significant number of arrows up, which points in the upward direction percentage-wise as a high probability investment from the buy side. It also points to this period here, of 3 weeks in April, as a very bullish time frame. But what's the most important thing? The most important thing is, will it happen this year? The answer to that question, as I said before, rests specifically in detailed timing, answering the question, are we in an uptrend or in a downtrend at this time. I respectfully submit to you that I see nothing right now on the horizon, technically, that could change this pattern, which has been in existence for over 120 years. Now, let's ask the why question. Even though mine is not the reason why, mine is but to sell and buy, the why question. The why question is very simple. Why do most of the charts look like this? Why do most of them begin at the low in January and end at the high at the end of the year? Simple. Because the secular trend, by which I mean the long-term, ultra-long-term trend in stocks, has been higher since the late 1800s, early 1900s. Therefore, most years will look like this. But we can do something else, which I find to be truly amazing. But let me give you some backdrop on this first. Since I'm an older trader, about to be 78 this week, I remember in the past when you looked at a bunch of data, for example, let's say you got a computer program in the 1970s or early 80s, and you took a vast amount of data and asked the question, are there any patterns or cycles in this data? Are there any repetitive patterns here? Are there anything we can use for investing or trading? And you did a number crunch. And you crunched the numbers over and over again. People would get angry and they'd say, that's not valid. You're data mining. You're mining for data. The issue is not whether you're mining for data. The issue is, are there any patterns that can be found? Nowadays, things are very different. Data is the name of the game. Traders, investors, quants are dying for data. The more data they can get, the more learning they can get into their AI models. So things have changed. And so we look at a vast amount of data and ask the question, what can we do with this? We can take one more step, which I'm going to take with you right now. And then before I run out of voice, I want to show you something truly amazing, which you're going to find difficult to believe, but I go through this every year. I'm going to go to seasonal trades. I'm going to look at US stock trades. I'm going to ask a moment, please. I'm going to ask a global question. For the Dow Jones, I'm going to come down to the Dow Jones here again. So just bear with me. Back to 1950. Moment, please. We're almost there. See? Like so. I'm going to say for the entire year, please. Looking at it, the year in history. Has there been any pattern, a specific pattern in the Dow Jones that has been accurate 80% of the time or more since 1950? In other words, what I'm doing is a search. I'm asking the question, has there been anything repetitive value with 80% probability over the entire year, dating back many years? So I'm going to do a search. The computer's going to do what it's best at, which is to start looking. Comes up with, no, nothing has been 80% accurate. No problem. I'm going to do some research. I'm going to ask for 75%. I think you will agree that if there's been anything that's been accurate in terms of patterns, 75% of the time or more since 1950, we have something that's viable and possibly investable and tradable. So here we go, we're repeating the search. And here's a search. And it says no. Understandable. Let's go back and ask another question. Let's say that we're asking for 70%. I'm going through this process with you so that you can see how we do some seasonal research the difficult way. Now AI can do this very fast. So let's ask the question. Dow Jones, 1950. do a search, and we have nothing. So we know something, that there has been a very specific pattern during all this time, but let's try something else. Let's increase our time span, or let's decrease our time span. Let's do it this way. Just bear with me, folks. And by the way, as you can see, none of this is rehearsed. We're going to go back to 1920. It's the same question. Is it possible that more data will give us a better result? It certainly is possible. Let's find out. Let's do a search for 80%, 70% or higher. And here we go. And the computer says, yes, indeed, there has been a pattern buying stocks October 26th, 25th, 26th, getting out January the 6th of the next year. That has been correct 82% of the time. And it looks like this. Here's the history. So we're talking over 97 years of history. And here's the results. So we found our pattern. We asked for 70%. We got 82%. We included a vast amount of history. And this is the result. So this is just one step in the process. We can go back now and do something else. We can say, tell you what, we are short-term traders. We're interested in shorter-term patterns. So we're going to go back to the search and say, I'm only looking for trades for investments that have a length of 25 days or less. Because remember, the average trader will not be able to hold on to a position from the 26th of October until January unless that position was a losing trade. Because as you well know, traders get out of their losing trades very slowly. They get out of their winners very quickly. And that's the nature of the beast. So let's look at short-term opportunities during this period of time. And what do we have? These have some very good ones. December 19th through January the 4th. And we can look at the history again, like so. See 97 years of history. And we can also see hypothetical results, like so. So looking at this chart, let's talk about psychology for a moment. Psychology is this. Noticing the rapid growth of this relationship over the last 10, 15 years, the average investor would likely say, it's done too well, it's time to pull back, it's over, I'm not going to do it this year. Besides that, the fundamentals are terrible, the world's on the brink of disaster, I can't do it. Strongly suggest you think otherwise. Let me show you one more thing. Before I run out of voice, I'm going to go back to the search. I'm going to do the same search in futures. Seasonal trades futures. And I'm going to search the stock index futures, S&P. Excuse me. S&P. Like so. Just bear with me. Search succinctly October and see if there's anything there in October. And I can put in a risk percent. Say, I don't want to risk more than 6% as an example, and show me trades or patterns that have been right at least 75% of the time during October, and do a search. Short-term patterns, 25 days or less. And the reason I'm demonstrating this to you is the future is predictable, not perfectly so, but amazingly so. And here you go. Here's a pattern that's been right 89% of the time. October 27th, remember that date, to November the 5th. So we're looking at a very short period of time with almost 90% accuracy. And here's the history. 28 years. And here are the results right here. Now looking at this chart, excuse me, you'll be inclined to say, it's done too well. My inclination is this. If the pattern and the trend show positive in the upward direction on the entry date for this trade, this is a trade I'm interested in. Granted, not as much history as the ones I showed you before, but certainly enough to make a decision. So what have we learned today? Hopefully you've learned a lot from me, specifically about seasonality. But remember, there's always a risk of loss. You need to be very careful with managing your risk, because remember, your game is played best if you manage risk. Your job as a trader or as an investor is to manage risk. And if you're doing that, everything else will take care of itself. Should you have any questions, feel free to write me. The foundation the foundation will be glad to relay your messages to me, or you can use my email address, which Dan may include on this recording. I apologize for the lack of voice. Hope I've gotten my message across to you. And remember, it's not perfect. It's a process. You need to use the setup with a trigger, with timing and risk management, as well as profit maximizing strategies. We're not perfect, but we try very hard. Thank you, Foundation, for giving me the opportunity to present.